$340. That's what disappeared from Margaret Ellison's checking account on a Tuesday morning in Dayton, Ohio. She was 63 years old. She'd never missed a payment on anything in her life. And she found out the way most people find out. Not from a phone call, not from a fraud alert, but from a line on a bank statement she almost didn't bother opening. A gas station in Florida, a state she had not set foot in for 11 years. Now, here's what I want you to understand about Margaret, because it's the part that should scare you. She did everything right. She caught it. She called her bank that same week. Well, inside every deadline the law gives her. She had the statement in her hand. She had the date. She had the merchant. She had every single thing you're supposed to have. And it didn't matter. The money stayed gone. Not forever. I'll tell you how that ended. But for long enough that her mortgage payment bounced and her car insurance lapsed, and she spent 19 days calling a fraud department that kept telling her the same sentence. We're still investigating. 19 days. Locked out of her own money, while the bank decided whether to believe her. And the entire reason that happened, the whole reason, comes down to which piece of plastic she pulled out of her wallet that week. Not a scam she fell for, not a link she clicked. She used a debit card. The card almost every person watching this uses for gas, for groceries, for the pharmacy, for Amazon. That card is not what you think it is. It does not protect you the way the other card in your wallet protects you. And the gap between those two, the gap that federal law leaves wide open, is the single most expensive thing most retirees don't know about their own bank account. I'm not a lawyer. I'm not a CPA. And nothing in the next 15 minutes is financial advice. It's a warning, and I'd treat it like one. The education is here. The specifics belong to a professional who actually works for you. If you've got a debit card in your wallet right now, do me one favor before we go further. Leave a comment and tell me what you use it for. Groceries, gas, online. I want to see how many of you are standing exactly where Margaret was standing. Let's talk about what a debit card actually is, because the marketing has done a very good job of hiding it. A credit card is a loan. When someone steals that number and runs it, they are spending the bank's money. The bank is out. You are not. A debit card is not a loan. A debit card is a straight line into your checking account. There is no buffer. There is no middleman. When a thief runs your debit card, the money leaves your account the moment the transaction clears. The same account your Social Security check lands in. The same account your mortgage comes out of. The same account you've spent 40 years filling up. That money is not flagged. It is not pending review. It is gone. And you are the one standing in the hole while the paperwork catches up. Now, you've probably heard that you're protected. You've heard the phrase zero liability. Your bank may have even printed it on the mailer that came with the card. So let me show you what federal law actually promises you. The rule is called Regulation E. It comes out of the Electronic Fund Transfer Act, and it governs every debit card in this country. And Regulation E does not give you one protection. It gives you three. And which one you get depends entirely on how fast you catch it. Tier 1, you report the unauthorized charge within 2 business days. Your maximum loss is $50. That's the good tier. That's the one they put in the brochure. Tier 2, you miss that window. Because you're on a cruise, because you're in the hospital, because you're a normal human being who does not audit their bank statement every 48 hours. And you report it within 60 days of the statement going out. Your maximum loss just jumped from $50 to $500. 10 times higher. Same theft. Same card. Same you. The only thing that changes is the calendar. And then there's Tier 3. Tier 3 is what happens when That fraudulent charge sits on a statement for more than 60 days before anybody reports it. Under federal law, at that point, your liability is unlimited, not 500, not 5,000. There is no ceiling. Regulation E does not require your bank to give you a single dollar back. Whatever the thief took, whatever was sitting in that account, your federal law does not force anyone to make you whole. And think about who misses a 60-day deadline. It's the widow whose husband handled the money for 38 years, who is now sitting down with a bank statement alone for the first time in her life, with nothing suspicious going on, so she isn't looking for it. That's who Tier 3 catches. And here's what makes it worse. A thief who steals a debit number rarely takes it all at once. They test it. $4 at a gas pump, $9 at a drugstore, small enough that it looks like something you forgot, small enough that it doesn't trigger a call. And then, once they know the card is live and nobody's watching, they empty it. By the time you finally sit down with that statement, the 60 days may have already run out on the first charge, the little one, the one you'd have shrugged at anyway. I want to hear from you on this one, and I want you to be honest. When was the last time you actually went line by line through your bank statement? Not glanced at the balance, read it. Comment yes if you've done it in the last 60 days. Comment no if you haven't. I don't think most of you are going to like your own answer. Because here's where Margaret's story gets worse. She did answer yes. She caught it inside the window. She was in Tier 1, the best tier the law has, and she still lost access to her money for 19 days. Everything I just told you was about how much money you're allowed to lose. Nobody told Margaret about the second problem, the one that has nothing to do with liability caps at all. When you dispute a debit charge, the bank does not hand your money back and then go investigate. That is not how it works. The bank freezes the disputed funds and investigates first. You are out the money the entire time. It sits in limbo, not yours to spend, not officially the thief's, just locked. And how long can that take? Regulation E gives the bank 10 business days to investigate a standard transaction before it has to give you provisional credit. 10 business days is not 10 days. That's 2 full weeks on a calendar, and that's assuming nothing lands on a holiday. If the transaction happened out of state, like Margaret's did, a gas station in Florida when she lives in Ohio, the bank gets 20 business days. 20 business days. That's a month. And that phrase, provisional credit, is the one people misunderstand most. Provisional credit is not the bank saying you were right. It's the bank saying, here's your money back for now while we keep looking. They can take it away again. It is a loan of your own money extended to you by an institution that is still deciding whether to believe you. So run Margaret's month with me. $340 gone on a Tuesday. She reports it Friday. Tier 1, $50 maximum, the best protection the law gives. And then she waits. Her mortgage auto draft hits, and the account is short. It bounces. That's an overdraft fee from her bank and a return payment fee from her mortgage servicer. Her car insurance premium runs a week later. Also short. Also bounced. She's now paying penalties on money that was stolen from her in an account she can't access because of a card she used to buy gas. And I want you to be angry about the right thing here. Those fees are not fraud. They're a consequence. The theft was $340. The damage was $340, plus a bounced mortgage payment, plus 2 fee structures, plus a lapsed insurance policy, plus 19 days on the phone, with a fraud department that would not give her a straight answer. You weren't robbed once. You were locked out of your own money twice. First by the thief, then by the investigation. And nothing about that was a malfunction. The law worked exactly as written. The $50 cap did its job. The system did its job. And a system doing its job still left a 63-year-old woman without her mortgage payment for 3 weeks. Now, if that's what happens when a debit card gets hit, what happens when a credit card gets hit instead? Because the difference between the two is not a matter of degree. It's a matter of whose money is on the table. A credit card is governed by a completely different law. It's called Regulation Z. It comes out of the Fair Credit Billing Act. And I want you to hear the difference in one sentence. Under Regulation Z, your maximum liability for unauthorized use of a credit card is $50, flat, full stop. Not $50 if you're fast, and $500 if you're slow and unlimited, if you're unlucky, $50. Whether you catch it in 2 days or in 60 days. There is no cliff. There is no clock quietly running out on you while you're in the hospital. The number does not move. And in practice, most issuers waive even that. $50 is the legal ceiling, not the usual outcome. A huge share of card holders end up paying nothing at all. Now hold that next to what we just walked through. Same thief, same stolen number, same 63-year-old woman. One card caps her exposure at $50 forever. The other card takes the ceiling off entirely if she doesn't happen to read her mail fast enough. That's not a fine print difference. That is two completely different bodies of federal law. And which one covers you is decided by which card you pull out of your wallet at the gas pump. But the liability cap isn't even the biggest gap. The biggest gap is whose money sits frozen while everyone argues. When a fraudulent charge hits a credit card, that charge is a line item on a bill you have not paid yet. You dispute it. The disputed amount is set aside. And here's the crucial part. You are not out a single dollar in the meantime. Your checking account is untouched. Your mortgage draft clears. Your insurance premium clears. The money the thief spent was never yours to begin with. It was the bank's. Margaret's mortgage bounced because a stranger in Florida spent her money. On a credit card, that stranger would have been spending the bank's money, and Margaret's mortgage would have cleared on schedule while the two of them worked it out. And there's one more piece almost nobody knows, and it's the piece I'd tattoo on the inside of your wallet if I could. Under the Truth in Lending Act, on an unauthorized credit card charge, the burden of proof is on the card issuer. They have to prove the charge was authorized. You do not have to prove you didn't make it. Turn that around and look at the debit side. Margaret spent 19 days on the phone, essentially trying to convince a fraud department that she was telling the truth. She was the one doing the proving. On a credit card, that pressure points the other direction. The issuer has to come to you with evidence. Same crime, same person, opposite legal posture, decided entirely by a piece of plastic. Now, I want to be straight with you because I'm not here to sell you a credit card and I'm not going to pretend this is free. Same crime, same person, opposite legal posture, decided entirely by a piece of plastic. Now, hey, if a credit card is a debt trap for you, then keep the debit card. That's a real reason, and I'm not going to talk you out of it. Just don't let that card touch the account your mortgage comes out of. Which brings us to what you actually do about it. 3 things, and none of them cost you $1. Start with the swap. Move your everyday spending, the gas, the groceries, the online orders, the restaurant tabs, onto a credit card and pay it off in full every single month, not carrying a balance, not paying interest, paying it like a debit card on a 30-day delay. And I want you to see the arithmetic on what that swap buys you because it's not abstract. Run Margaret's exact theft through a credit card instead. $340 stolen at a Florida gas station. Under Regulation Z, her maximum exposure is $50. And in practice, most issuers waive that to zero. So call it zero. Her checking account is untouched because that thief never had a line into it. The mortgage draft clears. The insurance premium clears. There's no overdraft fee because the balance never dropped. There's no returned payment fee because nothing bounced. And she isn't proving anything to anybody. The issuer has to prove she authorized it. Same theft, same amount, same woman. The bill for that day goes from $340 plus bank fees, plus servicer fees, plus a lapsed policy, plus 19 days of her life, down to zero and a phone call. Then deal with the debit card you're keeping, because some of you need one. For the ATM, for the credit union, because that's how your Social Security lands. Fine, keep it. But get it off your main account. Open a second checking account. Move a small working amount into it. Whatever you'd actually pull from an ATM in a month, $200, $300. Link the debit card to that account and leave your real money. The account with the mortgage draft, the insurance premium, the balance you've built, sitting behind a card number no thief has ever seen. Do that, and the worst case number stops being your balance and starts being $300. That's not a liability cap. That's a ceiling you built yourself, and no regulation can take it away from you. And the last piece takes about 4 minutes. I'll turn on real-time transaction alerts. Every account, every card, text, or email. No minimum dollar amount. Understand what you're actually buying with that. Tier 1, $50, if you report within 2 business days, is worthless to somebody reading a paper statement 3 weeks later. It only exists for people who find out fast. An alert on your phone is what turns that 2-day window from a legal technicality into something you can use. It's the difference between catching the $4 test charge on the day it happens and catching it after the 60-day clock has already run out on it. Swap the spending, firewall the debit card, turn on the alerts. None of this stops fraud. Nothing you do stops a skimmer on a gas pump in Florida. What it does is decide whose money is standing there when it happens. And if you know someone who's still running everything through a debit card, a sister, a neighbor, someone widowed and handling the money alone for the first time, send them this. That's the person Tier 3 is waiting for. Don't do this on the weekend. Don't do it when you get around to it. Pull up your bank account today and go back 60 days. Not the balance, it's the transactions, every line. If there's a $4 charge you don't recognize sitting in there from 6 weeks ago, you are already inside the window where the law still helps you. And you have days, not months, to use it. And then make one phone call. Ask your bank a single question. Can I move my debit card onto a separate account? They'll say yes. It takes 20 minutes. Most people never ask because nobody ever told them there was a reason to. The reason is the account you'd be protecting. Margaret got her money back 19 days late after a bounced mortgage payment and a lapsed insurance policy and a fraud department that never once called her first. But she got it back. The law did what it was written to do. There's another version of that Tuesday. Same thief, same gas station in Florida, same $340. In that version, she never knew it happened until the alert hit her phone. And it cost her a phone call and nothing else. Not because she was smarter, not because she got lucky, because she was carrying a different card. That's the whole difference. It's sitting in your wallet right now, and you get to decide which one is standing between a stranger and everything you've built.